behind schedule. I'm trusting that I'm able to do a lot today, and I must be able to do a lot today. So if you can see my screen, let me know. Is my screen visible? Can you see my screen, please? Everyone in there, can you see my screen? Okay, good. Thank you very much. Let me go straight to where we were last night. So we looked at I compiled some peer data. I told you that I'll complete the rest. In some cases, we still have some data, data not provided, like in case of Fidelity, because I could not find the annual report. So it's difficult to get a breakdown of the customer deposit. So I could get the abridged version, the financial statement. And so these are the top 5 banks I'm going to be using. And so for the non-CASA, I couldn't get that. For the gross loan, I could not. Or I should be able to. For investment, I could do for GCB quickly. I'll be filling this later. I can fill this side. Some of the banks I don't have. Total assets I had for all. Total equity. So while we do this, I'm using this thing to teach as well. But in practice, you try as much as possible to get a good data set. Right? This is not quite bad to use for this work we are going to be doing. So we were on the base case assumption, and we're going to continue with the development of the base case assumption. And from the base case, then we see how the rest go. So let me see something. Okay, no, Sam is saying he could see my screen. All right, so we're on customer deposits. This is what we're doing yesterday. Let's get into it right away. So I put together this of the nominal GDP, as you can see. The simpler formula I use here for nominal GDP is just I took the real GDP and added inflation to it, year end or end of period inflation, right? That's what I did to get the nominal GDP, as you can see. But then, as I mentioned, would have been done better, right? But I'm just using that simple approach so I can show you what I wanted to do. So we had this calculated for GCB, the current account growth, the savings account growth as well has been calculated, and we have the CAGR in each case. We looked at how we used the CAGR last time. Time deposits also have been done, and also have some info on the top 5 banks, the CASA growth. So the top 5 bank, if you recall, I grouped the deposits by CASA and non-CASA, right? So these are CASA deposits. And then we have the non-CASA deposits as well here. So we have all that presented. So this is the growth in the CASA, and this is the growth in the non-CASA as part of the deposit. Then I also have the macroeconomic data here and nominal GDP. The reason in that I explained something to you the other time that I see some form of a good relationship between the deposit growth and macroeconomic data, nominal GDP growth rate over time. And I showed you that when we're looking at, I think that should be the lecture on macroeconomics, right? We looked at something like that. Good. Now, so this is how we're going to approach the work. We're doing a base case analysis. We are not going to spend so much time arguing over the assumption. So we are going to first come up with a consistent growth rate, or maybe an initial growth rate over the forecast period. And from there, we will start looking at, and when we have the financial statement balance, okay, we'll start looking at how to adjust the base case assumption for some objective to be achieved. Okay, so we are not going to argue so much over the rate at which things should be growing, what should be the best growth rate and all that, but we're just going to do some simple analysis. Let's start with this. If I take the current account, for example, the current account, if I look at the growth since 2020, 2024, it's been growing at 37.4% on average. But then I have a CAGR of 36%. A CAGR of 36%, I could conclude that I want to proceed the growth at CAGR instead, right? So I want to get that done at the level of CAGR. And I'll do the same for savings account too. I'll do the same for time deposit. But if you check the top 5 banks, you see CASA is growing at 36% for the top 5 banks. And then let's check the top 5 banks and the CASA and see. But I think I have for all, in exception of Fidelity. So that's actually biasing. It's introducing some bias into my calculation because I don't have for Fidelity. So I'm going to use a simple approach to fill in for Fidelity. What I'll do is that I'll calculate the historical CASA ratio, CASA to total deposit ratio. See, this CASA and this total, this is CASA for Fidelity divided by total deposit. What am I doing? This CASA for Fidelity divided by total deposit for Fidelity. And so historically, I want to see the CASA to whatever ratio. And that is averaging around, let me see, around 75%. So 75% CASA, that's the average. So 75% CASA, but I don't want to do just historical average like this. Let's look at 2023. Look at 2023, 78. I think it's shifting more towards CASA. So let me pick 78.6, but let me just pick 78 as a ratio of CASA to total deposit in 2024. Let me just do something like that, 78. So I'll come here, I'll take the Fidelity, I'll multiply by 78%, 78%, and that gives me this. Then I'm going to, if this is 78%, then otherwise will be 22%. So that's the non-CASA will be 22%. So multiply that by non-CASA, 22%. All right, so I think I'll have a better CAGR to work with. So coming here, the CAGR is now 40%. So just think about it. The top 5 banks, their deposits have been growing at 40%. I mean, the CASA deposit has been growing at 40%. Non-CASA at 21%. So GCB alone is growing at 36%. But in 2024, GCB grew at 74%. But the CASA is 36%. To be on the safer side, I would like to do the projection based on CASA. Based on CAGR. I mean, CAGR, I was talking about CASA. Based on CAGR. And you also see that the CASA component that is growing most is the current account and not the savings account. Savings account is 26%, but current account is about 36%, growing really fast, right? It's actually dominating. And so these have some implication because what it means is that the interest cost the interest cost or the interest expense as percentage of the deposit may be declining as a result, right? Because current account attracts no interest. And if current account is dominating the CASA, then the cost associated with CASA, the cost of funds should be lower, all things being equal. And so I'm going to take the CAGR and I'll do all the growth based on CAGR. That's what I'm going to do. That's my base case to start with, right? So I have this done here. Apply the percentage and I'm done. So this is what I want to do for the forecast period. So I want to base customer deposit projection on this. And that should be fine. Now, the next thing I want to do, let me check if there's any question there. No question. After customer deposits, I want to project funding. I want to build a model I want to look at I want to project the total funding, but to do for total funding, I should be able to do borrowings, right? I want to do borrowings. And then when I come here, I can do for total funding. Let me just show you this. Now, we've gone through all these things already. You know, we need total funding, but we have to finish with deposit first, which we've done. We need to also do deposits from banks and other financial institutions. And the next one, we need to do borrowings, right? Which one should we go with first? Maybe let's go with deposits from banks and other financial institutions. From there, then we will handle the borrowing. Now, so if you check the historical records, deposits from banks and other financial institutions, we have the current accounts and we have the deposit or the time deposit. So these are the two groupings. With these, we can use the issues of like growth in GDP and all that kind of stuff to do projections or to even justify it in any way. And of course, it's is accounting for a lesser proportion of total deposits or of total funding. If you check it, which we discussed before, it's accounting for just about 3.2% on average of total funding for a bank. So not quite significant, right? But we still need to do some projection. And we are going to do this projection based on KIGA, right? So what are we looking at? Deposit from banks and other financial institutions. Let's do that quickly. So we copy here, and I mentioned that in this particular case, we don't need top 5 banks. We don't need macroeconomic stuff. I didn't gather data on these top 5 banks for all this kind of stuff. And there are reasons too, because if the GCB is placing money with or depositing, or sorry, is receiving deposits from or is having deposits from financial institution, it may be from any of these top 5 banks or other banks apart from these top 5 banks, right? So this kind of like interbank transactions and kind of stuff. And I don't think looking at that at the level of the sector make any sense, because at the level of the sector, it must all sum up to zero. If you look at the, or net off to zero, if you look at the nature of interbank transactions. Yeah. So I'm creating these particular assumptions again. So this one, I'm calling it deposit from banks and all the financial institutions. Deposit from banks and other financial institutions. Now, so we have current accounts, and then we have time deposits. So I'm just trying to leverage on the table I had above, right? So what we do here. Now, I told you, because we are going to do the projection based on YOY, we'll go to the historical analysis that we performed already and go to funding, and then go fetch your year-on-year growth. Okay, so this is the year-on-year growth for the total, and this one I want to take the year-on-year growth for current, and then time deposit is just below. So I can drag that down and then to my right, and so this is all I have, and as recorded in the funding tab. So this is all we have here. Good. Now, so from here, we need to look at how the future will be like. So we need to calculate some KIGA. So let's look at the KIGA. So over a 5-year period, comma, then the present value and future value, we go to, we go there. So we just look for the present value for current account is this, comma, the future value for current account is December 24. So then we drag down. So this is all we have. But here I put in a formula to pick only the KIGA. So that's why you see this happening here. If you look at the current account historically, for the deposits from banks and other financial institutions, the growth is quite erratic, right? So it's quite difficult to say we will project based on maybe average of this, why, whatever. But the KIGA is making some sense here, and the KIGA is making some sense. But when you get to time deposits, you have a decline significantly here, an increase again, an increase, then a significant decline. This significant decline in 24 actually is causing the KIGA to move to negatives. Maybe what we can do is that, based for the projections here for time, we will not use KIGA, but for current account, we can still maintain a KIGA. So let's just say for time, we want to use the 2022 or the average of 2021 through to 2026, but that's also going to be too high, because time deposits, we don't expect things like this to be too high, right? The growth to be too high. That's about 17%. I prefer that I pick just the 8.4% here in 2022 to start with, just to start with my model. Now, so this is also for deposit from banks and other financial institutions. The next thing I want to do would be for borrowings. So I will just copy these and paste below and do for borrowings. I always want to give about two rows intervals, right? So I'll have here borrowings. And so here will just simply be borrowings. Borrowings. I believe the borrowing is just one item. Let's check it out and see. So when you come to the funding side here, we are borrowing just one item here. And I prefer to just do this on a year-on-year growth rate. Look, when I build this model specifically, let's say for bank internally, when you just have a financial model, I may be doing more detailed work than what I'm doing here. Here, because we're doing these things for valuation purpose. I'm not saying what I'm doing is not detailed, but it may be more detailed than even what we're doing here, right? So we will be doing that also on a year-on-year basis. So I come back to my base case assumption, and then I put my equal to, then I go to where we have funding, and then I pick up the year-on-year growth here, and then I drag. So I want to study that as well. But before then, let me work on the CAGR. So the CAGR RI, then we have over 5 periods. The growth is over 5 periods. I go to my funding tab, and then I pick the opening or the present value. Then the future value is 2024. I hit enter, again, the CAGR 43. That is too high, but you see, the whole idea is that in 2024, there was a significant borrowing, and that caused this to increase to 153%, increase by 153%. That may be too high for us to start building the model. We don't want to forecast borrowing to be growing at this high rate, given that the bank strategy is actually to mobilize CASA, or current account savings account deposit. So one thing we can do is that we can put the forecast on average of 2021 and 2022, maybe something like that, over the forecast period, and that put about 14.7% annual growth in borrowers, which makes some sense, right? Is there a question? There's no question. Now, so far for the funding, we have built the template for the base case assumption. Let's proceed. So one thing I'll do here is that I'm going to bring this down by 2 rows. And so I brought that down by 2 rows. And in row, or in cell C8, I want to type funding. So I'm typing funding, and then maybe I want to increase the font size to 16. And this funding, I want to group all the fundings under that, all the assumptions about funding under that. So I come here, I go to data, and I go to outline, and the outline, I clicked on group. And so it has grouped all that under funding. Now let's move to the second category. And the second category, I want to work with earning assets. So earning assets. Now, the earning asset, that's what we start looking at, the various classes of earning assets. And we discussed that in detail. We're talking about the loans, and we're talking about investment securities, but that's not all. The loans can further be classified into the loans to customers, loans and advances to customers, and also advances to other banks, right? The advances to so we also have advances to other banks. There's something I want to say, but I'll say later. So those are the 2 classes of loans we have. So if you look at it, generally, the earning assets will cover the investment securities, will cover the advances to other banks, and finally we will have the loans and the loans and advances to customers. So let's start with the loans and advances to customers. And what we're going to be doing, we're going to do this on the basis of gross loans, right? Gross loans and advances. I think I copied from here, so I can paste this for customer deposits and just edit. So gross loans gross loans and advances. Gross loans and advances. And let's see, we have about 3 types of loan. One is term loan. I know them offhand because of course, we discussed those things at length, guys. I believe you could recall. The second one is overdraft, and the last one is staff loans. So we have staff loans. And also the top 5 banks. Well, I want to focus on just the gross loan for the top 5 banks. So gross loan for top 5 banks. That's what I want to focus on. And so let me delete everything I have here. So I have enough space created. Okay, so nominal GDP growth, I still maintain it here for now. So the term loan, overdraft, and staff loan, we are going to base the projections for gross loans also on year-on-year growth, right? We discussed that last time, and so I look for earning assets, and I look for the growth in gross loans and all that. So the first one is gross loan. That's for the total gross loan. I'm not interested in that. The second line is term loans. That's what I'm interested in. And I have overdraft just below that and staff loan just below that. So I start with overdraft. So I can, because of the arrangements, the consistency in the arrangement, I can actually drag freely, right? And I can also calculate my KIGA, RRI, and so 5, comma. Then I will go there, and when I get there, I'm going to pick the first one here, the present value, which is the beginning, then the future value, which is the 2024 figures, as we always do. Then I drag down. Now, for the gross loan for the top 5 banks, let's look at them. Top 5 banks gross loans. We don't have a Fidelity Bank. You see, the issue with Fidelity Bank is that because we don't have the annual report, is difficult to get those details of top, the actual gross loan from there. One thing I can do is I can base this work on actually maybe the growth up to 2023 instead. Since I have information up to 2023, but EcoBank too, I have a bit of a challenge in terms of how things were classified in the previous year. So I actually have data only up from 2020 to 2023. I need to manage that. I'm going to say that as far as the gross loans are concerned, how I'm going to do the year-on-year growth. Let me just say gross loans. The year-on-year growth calculation, I will be interested in just the calculations from 2020 to 2023. Those are the ones that are going to make great sense. In fact, even 2020, not really, because we don't have the opening balance here. So only 2021 to 2023 are going to be that important to me. So when I come to this side, I'm looking at from 2021 to 2023. So I come here, I pick the 2021. I want to look at it only up to 2023. And the KGA too, I'll do a similar thing. So RRI, so this is going to be a 4. So a 3-year period of growth. You can see the only 3 growths we've calculated here. The present value will be for 2020, and then the future value will be 2023, right? So present value will be 2020, and future value will be 2023. So that is what we have here. And so 18.9%, that's the KGA here. And now, so let's see how the projection will go. I put in, because of the formula I put in from the other ones above, it's speaking it just like that. If you look at the term loans here, it's kind of like erratic, right? The growth is not consistent, even though it's recording positive growth throughout the is recording positive growth throughout, but the growth is not really the deviation is very high. If you calculate the standard deviation is high, and it's even worse when you look at it in terms of the overdraft. It's even worse, and when you look at it, there's staff loan too is quite bad. So to start with, I will want to base this on KGA. And when you look at it in terms of the industry is giving you, that's the top five banks, it's 14%, 32.12, which is giving a KGA of 18.9. GCB is a big bank, and so if it's growing at 24%, it's not out of place. Maybe also let me get the GDP figures and place them here. The GDP figures and place them here. So, well, of course, all these banks are growing above GDP, right? In terms of the deposits we saw earlier were growing above GDP, and that is not too bad. We are seeing a growing economy, right? So I would like to base this on KGA, the initial values on KGA. So I'm picking this KGA just to build the initial model on KGA. Then, so this is gross loans and advances. I will want to also look, so I want to see all the gross stuff, right? So let's also look at the gross investment securities. So the gross investment securities, next to look at gross investment securities. Let me get them pasted here. I think there's a question. Isn't the KGA calculation based on a 4-year period instead of 3? Yeah, it's based on a 4-year period, but the growth is 3 years, right? It's always n-1. I explained that yesterday. So if we look at, for example, if we look at data between, look up here. So we're looking at from 2020 to 2023. That's a 4-year period. Okay, 4-year period, but how many times did we experience growth? The first growth was from 2020 to 2021. That's 1. 2021 to 2022. That's 2. 2022 to 2023. That's 3. So that's why it's always n-1, right? Okay. Let's look at it further. A moment. Let me delete all this here. So now we want to look at gross investment. So, well, the investment, if you check what we've been doing, we have short-term investment, the groupings of or how GCB present their financial statement. We have short-term, we have medium-term, investment, and we have long-term investment. That's the last one. So I'm just editing these things. I don't want to wait. Long-term investment. So let me just put the dash here as well to make this a compound word. Okay, so then coming here, we have gross investment, and nominal GDP is still here. Okay, so during the investments, before we even start, guys, I did this here, but let me say this. It doesn't mean we are going to use this approach. There's something I just want to show you. If we look at the investment, for example, let's just go there. Well, we go to look at the earning asset and we look for investment. Where it is here. It's going to be difficult to actually predict how a bank should be growing investment. Okay. The strategy of a bank, as we saw it in the business model of a bank, is actually to create loans, right? The whole business model is around creation of loans. But you may not always have to take on 100% credit risk, right? You can also add some risk-free instruments. And here I'm dealing with the risk-free from the perspective of a bank dealing with maybe different levels of risk, government securities versus credit, right? Private. But I'm not in any way alluding to the fact that government securities are risk-free. I'm just trying to make a case that, well, you don't want to take on a full credit and you want to get government. A full credit means that you are granting just loans. You want to also get some investment into government securities. It lowers your risk. Um, and of course, so you see that the business model is not to invest in government instrument, but rather to create loans. In that, you see that the business model associated with investment in government securities is kind of like, well, we mobilize deposits, we may put them on government securities, and as we have quality loans, we write them. We write loans, and then whatever is left to put on government instruments, right? So it's more opportunistic than a deterministic strategy. So since it's more opportunistic than deterministic, then the way I approach the projections and to the further is going to be difficult since it is opportunistic to come up with a deterministic growth rate. The way I'm going to approach this thing will be different. So there's something I'll be doing, and that's what I want to show you here. So to be able to project the investment securities, instead of doing investment like this, no, I'll do it this way. I'll look for something called, I'll look for loans to, I'll call this asset allocation. Asset allocation. And I'll call this asset allocation. And here below, I am going to have loans. I'll make it gross loans, right? Gross loans to gross loans to gross. I need to be a bit careful here because I'm going to use a certain term. I'll call it earning asset. But what I mean by that is that I mean, if I say earning asset, generally when we define earning asset for the work we are doing, we include advances to banks as well as loans and advances to customers. We include all those things in earning asset, and also includes investment securities. But for the purpose of what I want to do, when I say earning asset, I'm going to define it to mean investment securities and then loans to and advances to customers. So we won't include advances to banks, right? Gross earning assets. So I have loans. I have consumer loans, right? I'm sorry to say consumer loans. I have I don't have enough space here to do this. Or let me just put it this way rather. Gross loans gross loans plus gross investment. So something like this. Good. I think this is clearer. You get to understand what's happening. This is better than what I did first. Then I'll delete everything I have here below. And for the top 5 banks, actually, I want to get something like that for the top 5 banks before. But when I study the data I have, well, I have gross loans. For investments, I don't have for all how they are allocating their earning asset. Let's just check something quickly to see. If I take the gross loan here and I divide it by the sum of gross loan plus investments, let's see what we have. That's about 56. But because I've not brought that of GCB, which I can quickly do, I go to earning assets and I'm looking for GCB gross investment. So here is it. I just copy the whole figure. I'll go and paste as values. I don't want to paste formulas. So top 5 banks, I'll paste here at values. So we have 45%. So 45% of the total here is invested in gross loans by the top 5 banks on average. And when you look at it, it's around the 45%, 43%, then 51%, increased to 51% in 2022. And that was because of the DDP, right? It makes investment significantly drop through the impairment charge on investment. And that makes the loans to artificially rise. And then it dropped again to 45% in 2023. And that's how the industry is showing. Maybe I can do that here. Let me not ignore it. Let me just maybe do the calculation formally here. So I'm looking basically at the gross loans gross loans, maybe even to say doing the calculation at the top is even better under gross loans, since gross loan is a center for or center of the discussion. Gross loans to gross loan plus investment, which is also gross investment ratio. So I can delete all these growth things from here. Let's see how it looks like. So I am looking at gross loans, the total here, divided by the sum of the same gross loans plus investment securities, as you have here, you see it. And then when I drag, some of them will not be that important to me. For example, this will not be that important to me because of the data. I don't have data here, and here too I don't have enough data, so I'm going to be considering the ones in the middle here. They are the ones I really want, right? However, I'm going to bring all of them here to start with. So I'll put the same thing here. So this will be for the top five banks, and let me bring that there so that we add that to it in the discussion. Okay, so but I mentioned that I don't really care about this one and the last one, so let me take them off from here. And KGA is not applicable. We don't care about KGA when it comes to those kind of ratios and stuff. Now, for the bank, how we do that calculation, let me just do that here. If error, then I go to earning assets as we have it here, and I pick the gross loans and advances to customers, then divide by the sum of the gross loans and advances to customers plus the gross investment securities. Now, there are some few things I'm going to be saying soon. This will not work. I have to add the not applicable to it. I'm going to talk a lot about this issue of loans and impairment and things very soon. They are not that easy for many people to understand. But this is the ratio. We're talking about gross loan taking 40% of the total earning assets. We've exempted advances to other banks from here. 33%, then 34%, 39%, 37%, and 44%. Of course, there have been an improvement over the years. And it makes a lot of sense because of the new cash reserve ratio to the bank. So a lot of banks trying to comply. And so GCB reflecting in the 2024 numbers, you see that their loans are now taking about 44%. It was lower earlier. In 2022, it appeared higher because of the DDP, and then it dropped in 2023, and then the regulatory demands on them has caused them to increase granting of loans, as we have here. This is not applicable for this side. And then for the forecast period, one thing we can do is that it may not be the best to go take the average of the historical period. Let me show you, because they are drifting the allocation of assets over time. And if you just take average of historical period, they give you 38. It appears as though going forward, they are going to maintain 38, but that's not true. If you see a strategy, the strategy is towards loans. Okay, so maybe a more conservative thing to do would have been to base it on 2024 to start with, right? Good. So do I need macroeconomics here? Yes, to some extent, I need macroeconomics as well, because I want to see how the economy is growing, and that will determine whether the forecast will be making sense. And how the economy is growing, I will require that we have some forecasts here, right? Forecast macroeconomic data. But currently, the historical, we still place them here because it helps us to understand the historical backgrounds to some of these things you're having here. So with asset allocation, I'm able to forecast investment as well. The next thing I would like to forecast will be the advances to banks. So let's work on advances to banks. Making great progress. So say gross advances to banks. That's the next thing we have to do. And the advances to bank, let's see how it is like. Earning assets, and we have advances to banks. Just single line or gross placement with other banks, right? Placement with other banks. So we will just come here and let's say, and we are doing that based on the growth rate, right? So gross, so we just say placement with other banks. Here we don't need a top five and all this GDP stuff, because when we're doing deposit with other banks, we didn't need those things. So here too, we don't really need them. So all that we need is this. So we can actually go to the slide and then pick it up from there. The growth rates, then we track. Then we go ahead to calculate the CAGR, RI, and what do we do? So 5 comma, as we always do, right? So these things are not new. Then we pick the gross here. Then you give it a CAGR. Now, if you look at the CAGR, you see that in 2022, we have 13.8, increased by 66% in 2023, and then by 187%. Of course, this kind of number sometimes is it's difficult to just go and pick arithmetic average of the historicals and the end things there. It doesn't make much sense, right? And maybe a CAGR will be cool. So maybe basing on CAGRs I've done here is good. So I will just end it up with the CAGR, and I think that should be fine. So that's gross advances to banks, as we have it here. So here we are able to come up with the gross earning assets, right? The earning assets at the gross level. Let me take off all these groupings. I don't want them here. So let me ungroup all of them. Let me ungroup them, ungroup. And then I want to group them. I want to group them all under earning assets. So these are the assumptions under earning assets. So I've grouped them essentially. So let me take off this. So I have my things well grouped, properly grouped. If I click on one, of course, I have things like this. I want to close this further. So just a moment. I can delete this now. So when I clicked one, I have my things well arranged. Okay, so I have my assumptions well grouped, properly grouped. Okay, now let's move to the next item. Now we've built the assumption template for customer deposits. We've done for borrowings. We've done for advances. For deposit from other banks. We've done for loans and advances to customers. We've done for advances to other banks. We've done for investment. Now, so when we go to the balance sheet here, we're able to see the things we have completed in terms of coming out with the structure. And so we finished the we finished the investment securities. Let me just do some color coding, right? Finished investment securities. We finished the loans and advances to customers. We finished advances to banks. We finished deposits from banks and other financial institutions. We finished deposits from customers, borrowings. We finished that as well. So these are progress so far. The next thing we will do is to look at other items on the balance sheet here. But before maybe let's complete the balance sheet. Let's look at other items on the balance sheet. Cash and cash equivalent often comes from the cash flow statement as a balance, so that's not something we need to look at now. Non-pledge trading assets, we can create assumption for this now. Derivatives, they had only in 2019. In periods beyond that, there's no derivative on financial assets, so we don't care about that. Investment other than securities, investment other than securities, we need to create assumption for that. Investment in associates, a subsidiary, deferred taxes, and all that intangible. We need to create something for all this, right? So let's start with non-pledged trading assets and see how it goes. When we go to other BS items, we see non-pledged trading assets. What is this? It is here, non-pledged trading asset. And the KPI we calculated for that was year on year, right? So that's the basis for which we're going to do the forecasting or the projections. So we come to the base and non-pledged trading assets is where we're going to now. So I want to group all that under a header I want to call other investments or other investment and assets. So other investment and assets and financial assets, right? Financial assets. Let me call it like that. Other investment and financial asset. Starting with the non-pledged trading asset. With the non-pledged trading asset, I don't care about the industry and all those kind of stuff. So non-pledged trading assets. So we're going to do a year-on-year growth there as well. Non-pledged trading, right? Year-on-year growth. So we go pick that quickly. Non-pledged trading assets year-on-year growth. We go to other BS items, and then we pick that there. Now, so we need to also calculate the KPI in respect of that, and that is RI, and I have 5. Yes, then at the beginning, so I go step in, I look for the opening balance here, and then if I say opening, I mean 2019 balance, right? And then I look for the future value as well. And so that gives me 38. Well, if you look at historically, it's been very erratic, but KGA is giving me 38%. Should I pick it? Oh, yes, why not? So I picked the KGA of 38%, and that is it. I'll do my forecasting based on that. Then the next thing I want to do, let me create some space. Okay. The next thing I want to do after that, if you check what we've been doing so far, we have the non-pledged trading assets also checked now. Maybe just permit me to move this worksheet to this area so it's closer to where I have my assumptions. So I've done the non-pledged trading assets, and what we are going to do next would be the investment other than securities. That's the next item. So let's handle that. Investment other than securities. So when we check the other BS items, let me also move that step back. We check the other BS items or balance sheet items. We have investment other than securities, and this has to do with the listed equity instrument and the unlisted equity instrument. If you look at that, we've done the year-on-year, and also we've done the percentage of the total. The projection definitely will be based on the year-on-year. But these are some of the things that we are not going to grow, because this has to do with a bank making equity investment and in other banks, and this equity investments, they may be classified as normal financial asset. Maybe GCB owns 5% equity interest in a certain company there and there, or just bought the shares of a certain company. And this involves companies that are listed on the stock market, and in some cases, they are not listed on the stock market. For when you're doing financial projection in this case, you don't grow those items. You keep them constant, right? Let's look at that. Investment other than securities. Let's look at that. So I come here, investment other than securities. There are 2 items I want to deal with there. So I copy this. I come here and I type investment other than securities, into bracket, other than securities. And so the first one is listed equity investments or listed equities. You can just say listed equities. And I'm interested in year-on-year growth, year-on-year growth. And then the second one is the unlisted equities. So I drag them down and just edit that. So with the listed equities and unlisted equity, the historical analysis is based on year-on-year growth. So I'll just come here and pick the listed equity, the year-on-year growth for the listed equities, and then the unlisted is just below that. Okay. Then we also look at the KIGA. But this is the point. The growth in the investment, not necessarily cash. Investment value will be growing because the share price on the market is rising. Even if the stock is not listed on the market, because you do fair value assessment or fair valuation at the end of every reporting period, you may have the fair values calculated to rise, even if you have not bought in new shares, right? Sometimes it makes it difficult to forecast, right? So we're not going to struggle or maybe give ourselves that additional responsibility to forecast these things. Who cares about that, right? It doesn't really affect my bottom line valuation. So the listed we have here, I've done the RI calculation, and then this one I have. So for the forecast period I mentioned, these kind of things, we don't forecast them to grow. Just leave them the way they are. But then we have placeholders just in case, right? Now, so we've completed which one is this investment other than securities is done. I mentioned to you that derivatives and financial assets, we don't really care about that because we don't have any even going forward. So there's nothing to worry about. So I'm going to highlight that also as though we've completed it, right? Next item here is investment in associates, then followed by investment in subsidiaries. Let's check that out. Investment in associates, when we go to other BS items, we have investment in associates, it's just a single line. And this one, I didn't even do anything about it. I didn't even do any growth rate calculation or whatever. You see, the reason is that some of these ones, we don't even care about the growth, right? And if you look at it historically, it's been constant. But then, just to fulfill our righteousness, let's just do something here so that it doesn't appear as though nothing has been done here. Let's just do something here, and I'll show you why that is going to become very important. When we are switching between various scenarios, you tend to see why that is important. That we have those ones also linked. When we start switching between scenarios, you see the importance of that. So I have my key performance indicators. Let me just do for growth rates. Let me do another one for here as well. So the top here, I'm looking at investment growth rate, and here to investment growth rate. That's been calculated already. The formula is consistent, and that is all I need, and it's been done. So what we do, we go to the assumptions as well and do the same thing. I just need one line. So I come here and I paste it here. Then I have investment in associates, and investment in associates, I edit it, I just call it investments, just to ensure everything is looking good. Now, so I'll just go and link that. So I go to other BS items. This is associates, I pick it up, I drag that, and then the KEGA RI over a 5-year period, and then I go back to the same other BS items, and then I pick the present value, then command the future value, I hit enter, and it gives me this. It's still 0. And the forecast period too, I'm going to maintain it as 0, right? We are not going to grow those kind of stuff. And investment in subsidiary too, we are not going to grow it, but let's get like placeholder, just like the way we did for investment in associate. So investment in subsidiary, we going to have the same thing. We go to other BS items, and then we pick this. Look, guys, when you're doing the model building, the initial growth rate, you put it just based on some KGA or something. It is after you build a model, everything is in balance, then you come back to refine assumptions, right? RI and 5, comma, then I go back to my BS items and I pick the initial, then the ending balance here. But then because we're not growing this one also, subsidiary, so the growth in subsidiary is also going to be 0, 0 throughout. Now let's check our progress. So we are done with associates, we are done with subsidiary, we are done, so we are left with, to complete the asset section, we are left with deferred tax assets, we are left with current tax assets, we are left with intangible assets, we are left with other assets, and they are left with property, equipment, and right of use assets. The whole idea is that when we come to equity, we are not going to really be making assumptions for equity. The only assumption we'll be making along equity will be dividend payment. So apart from that, no further assumption here. Then liability, you'll be having current tax liability, and you see that current tax liability is having some relationship with current tax asset here. So if we are working on current tax asset and current tax liability, they are the same, right? I mean, if I say the same, they are serving almost the same purpose. That is exactly what I mean by they are the same. They serve the same purpose. If we are working on one, then the other is also automatically being worked on because they tend to belong to the same family, right? A moment, guys. Any questions so far regarding what we are doing? Any question? Then before we proceed to look at maybe assets, we work on assets. Then from assets, we will start working on the taxes and all those kind of stuff. Then, all right. Okay, so just a moment. I received notification on something. Just brief moments on that. Okay. Okay. All right. So when it comes to issues of CAPEX and kind of like depreciation and all those kind of stuff, you see, some of these things are not that too much important to the banks like that, but then we still need to just to get completeness, right? Like issues of depreciation and stuff and all things that have significant impact on the value of a bank, right? So we don't really worry much about it. Unlike what we do with corporates, industrial corporates, that we so much concerned about that because consider a manufacturing firm, the whole production or the whole performance of the business depending on the fiscal asset, right? Not too much here. Now, so we want to look at the next item, and maybe we should look at depreciation. Maybe we look at CAPEX, right? And by extension, we'll look at depreciation. So let's look at depreciation. That's the next assumption. So let's get a depreciation policy because we will need depreciation. Why do we need depreciation? When we go to the assumptions, we have the fixed asset. In fixed asset, like PPE here, we need an assumption around additions to fixed asset. For disposal, we don't need to project that. We need, for revaluation too, we don't need to project that. For impairment and write-off, we don't need to project that. For transfers, we don't need to project that. All we need to project going forward is additions. Now, when we come to the accumulated depreciation column, we need to do projections for the charge, depreciation charge, which is the depreciation expense that goes to the P&L account. We don't need to do projections for disposal, because since we are not disposing of any assets, we don't need to remove the accumulated depreciation associated with the asset disposed. We don't need that as well. Write-offs and revaluation stuff and all those kind of stuff, we don't need any assumption around them. All we need is the depreciation charge and also additions to the asset. The same thing we're going to do for intangible asset. So let's check it out and see. So let's start with the depreciation, and then we'll come to the additions. Or maybe we can start with additions first. Additions to assets, asset additions, and another way we can call it, just call it CapEx, right? CapEx. And then with the CapEx, we have two types of assets we have to deal with. We have the fees, we have the PPE, so PPE, and then we have the second one, which is intangibles. Now we need to come up with a basis for forecasting these things, and it's not going to be growth rates. I don't like to use, and most people don't use growth rates. We cannot just forecast that your additions to total assets or the capital expenditure the bank will be doing will be growing every year. We wouldn't just do that. Maybe not that we can project that to grow back. Well, it's growing like at what rate? So something we can do is actually to handle something like CapEx to depreciation ratio. So we can do PPE CapEx, to depreciation ratio. So PPE CapEx to the depreciation expense for PPE, right? And you can also have intangible CapEx and to the amortization, because the depreciation of intangible assets is called amortization, right? Amortization ratio. I can add a ratio to it. I can leave it like that. Maybe let me add a ratio to it. So this ratio here as well. Now, I don't know if I've calculated that already when I was doing the historical analysis. Fixed assets, no, I've not calculated it. Wow, I'll have to do that. I'll have to do that. I will have to do that. So quickly, let me do that. So let me copy this and go do that there. Fixed assets. I'll go do that there under fixed assets. Okay. So what do I need first? I need CapEx to depreciation ratio, and then I'll need depreciation policy as well. So I can add all those things also here. So I have that as well. So average. So what I'm doing is that I'm doing average depreciation rates. You know, I explained something to you yesterday that I put all assets together and call all of the PP. All the PPEs, I put all of them together, right? And these are consolidated PP, right? I'm using. So CapEx to depreciation ratio, how do we calculate that? CapEx to depreciation ratio, that is the CapEx at the top here, can you see? Divided by the depreciation expense or the depreciation charge. And that's what I mean by CapEx to depreciation ratio. So here we go. And oftentimes I just take off the percentage. Average depreciation is this way. What I want to do for average depreciation, this is the way I calculate it. I take, and this is how I want to recommend you do it. You take the depreciation divided by the opening balance of the asset for the first year. Because the first year we don't have the previous period to compare with, so this is just for the first year. In the second year, this is what I want you to do. In the second year, this is what I want you to do. I want you to I want you to take the depreciation for the second year divided by the average of, so divided by the average of the opening balance, the average of the opening balance of the previous year, right? And the opening balance of the current year. In other words, look, don't be confused. In other words, what I'm doing is that I'm taking the opening balance and the closing balances. That's what I'm doing essentially. I can use sorry, let me just do something. Let me take my words back, guys. And so when I come to the beginning, I can still do something there. I'll pick the depreciation for the year and divide it by the average of the beginning cost and the ending cost, right? The beginning cost and the ending cost. This is what I can do. And that is what I have here. So the beginning cost and ending cost will give me the average historical cost of the assets during the year. The reason why I don't want to pick just opening balance is that during the year, some assets were bought. So they will be ignored. And the reason why I don't want to pick the closing balance too is that some assets may be bought in the course of the year. They may be bought closer to the end of the year, and they may distort my calculation. So I'm picking the beginning and the end, right, and averaging them. That's what I'm doing. I click enter, and this is what I have. So with this, I can drag throughout. With this, I can drag throughout. All right. So this is what I want to have here. And I'll do the same for the intangible assets as well. So come here for the intangible assets. I want to do the same. So let me see. I think it has picked it. Has it picked it correctly? So this is CapEx to depreciation ratio. So instead of saying depreciation ratio, it will be CapEx to amortization ratio, because the depreciation of intangible assets, as I mentioned earlier, is amortization. Let's understand in that sense. So I pick that, and that is picking it correctly. And when I come to this side, it's also picking it correctly. So my formulas are working quite well. Now, that being done, I can go back to the base case assumption and do the following. For the PP to depreciation ratio, I'll just go and look for PPE. And PP is at the top here. PP to depreciation ratio, PP CapEx to depreciation ratio is this. And then I'm also looking at intangible assets CapEx to depreciation ratio. And I'm looking for intangible asset CapEx to depreciation ratio, and that is also here. I picked that one, and I don't want them to be in percentages. So then I drag. The CAGR won't make much sense to me, so it's not applicable. Not applicable. Not applicable. Below as well, not applicable. Over the forecast period, what I want to do is that I want to go with the average. If you look at it, it's quite erratic, right? But things like this, I would like to just go with the average. So I go with the average CapEx to depreciation ratio, and that will form basis. And let me explain the rationale behind some of these projections. You know, if I do things on CapEx to depreciation ratio, what I mean is that, for example, CapEx to depreciation ratio means that, and I've calculated this to be, let's say, 1.67, right? Average of 1.67. Oh, sorry, I'm coming in. It's giving me a moving average, and that will create problem. I don't want it to be moving average. I just want it to be constant throughout. Okay, so I calculated that with 1.67. What this means is this. For every 1 CD of depreciation, you replace that with an investment of 1.67 CDs. Okay, so when the asset depreciates by 1 CD, we improve upon the total asset by 1.67. So over time, the asset base will be growing. That's what is happening here. I think there's a question in the chat box. Let me check. Why not the base approach for these two items? The base approach. The base. Ibrahima, could you please throw more light on what you mean by the base approach, right? I'll respond to that. Now, so we have the CapEx done, and to be able to come up with the fixed asset and intangible asset, I need CapEx, I need depreciation as well. So the next thing I would like to handle is the depreciation policy. I think Ibrahima has Nelson is saying something. He said, so what happens if there is an off-balance sheet activity like loan commitment or LC, which won't hit the P&L until it is actually realized? If it will be realized in say 1 year time, how do you forecast that since it will earn interest income? So this is what is going to happen. I will be talking about the loan commitment and the LC soon. I'll talk about it in relation to impairment charges, right? I'll talk about that. But when you say it's going to earn interest income, yes, I'll agree to some extent. But I think when we get there, we can look at this particular statement further. And Nelson, I've taken note of the comments there. We'll look at it soon. Now, so we have here depreciation policy. Now, so depreciation policy, we have here average depreciation rates, and here we have average amortization rate. So average depreciation rates, we go to the fixed asset again, and we pick the average depreciation rate, and that is PPE. Average depreciation rate is this. I don't know why my Excel is not responding. So that is 31. Let me type it in there. I have this, and then we pick the average amortization rate as well. So that is going to be this average amortization rate. I should have made it amortization. It's still there as average depreciation. I'll go back there to correct it right now. So that can be in percentages. And you know how we calculated that? We calculated that based on the beginning and the opening and closing balance of assets, right? KGA is not applicable here, and we'll continue with the average, right? We'll continue with the average. That's what we'll do. We'll continue with the average. We'll just use the average, use it to do our work. So I think I bypassed some few things I should have done. I should have done some further groupings. I bypassed that. For example, I call it other investment in financial assets, right? But when I finished that, I didn't group. It's actually up to subsidiaries. So let me take off the groupings I have here. Data, I go to outline and group, and then for the key persons tab, I give some space, enter, and then let me group this one so that I know these are grouped under financial assets or whatsoever. So let me group that nicely. Group. And one thing is that once you build a single model for one bank, it becomes, you are then able to use it for other banks as well, right? You just make some basic adjustment and then you're able to use it for other banks as well. And so here I want to call this fixed assets. Maybe let me copy this, and so fixed assets, fixed assets here. And we finish with fixed assets as well, because all we need is CapEx and depreciation, right? So we are done with fixed assets as well. So I come here and I group all this stuff here, and then I come further to group it. So once I collab or I clicked on one to group, I have my things nicely, or my assumptions nicely presented here. So I have my assumptions here. So let's proceed. So let me click back at 2 so I can have all of them collapse. Now, fixed assets, so we've just done. let's check our progress so far. We are done with property, plant, and equipment. An assumption around it, we have finished that. Then intangible asset too, we finished that. We finished intangible assets as well. So we are left with deferred taxes and and we are left with deferred taxes, right? The thing is that, are we going to project deferred taxes to be changing or whatsoever? Well, nobody really cares about that, right? Deferred taxes, nobody really cares about that. So it's one of those things that we're not going to care about. Let me go to where we have taxes. So other BS items. Let me see what we did to defer tax. This is how we presented it. We have the starting value, then a movement in deferred tax over time. And what we'll do is that over the forecast period, this movement are going to be zero. We will not have any movement again. Since there's no movement, the amount will be kept constant. And that's a standard practice. That's a standard practice each time we do the modeling, right? Deferred tax, we don't tend to, especially for valuation, but we don't really care about it that much. But it creates a bit of a problem if, let's see the kind of deferred tax we have. This is a deferred tax asset. Yeah, it's created a bit of problem, but for deferred tax asset to be considered valuable, the entity must be making profit, meaning that since you are making profit, meaning you can benefit from the tax benefit, right? I explained all these things yesterday. You can get a tax benefit, and the entity here is making profit. GCB is making good profit, so we don't really have problem with these deferred tax. So we don't care about deferred tax. So because we don't care about deferred tax, I'm going to highlight that as well as being done. Next thing, current tax. Current tax is what we need to work on now. So we need to work on current tax. And that's, again, when we work on current tax, then it means that we are indirectly working on current tax liability as well once we do the asset. The employee obligation is there. Then other assets and other liabilities, those are the next ones that we need to work on. So what are we going to do now? Let's work on maybe, or come back to the taxes, but let's work on the other assets and other liabilities for now. We'll come back to the taxes soon. The taxes actually are just the tax rate that we need, or maybe let's just work on the taxes now, so that we know that taxes are gone and we are just left with the other matters to handle. I mean, the other assets and other liabilities and all those kind of stuff. Then we're done. So we go back to the assumption sheets, and what we're looking for is just the tax rate you want to put here. So I want to call the remaining items others, others, and then the first one I want to deal with is corporate, or maybe just say taxation. And here, let me insert this down. Okay, taxation. Here we have corporate tax rate. We put the corporate tax rate here, corporate tax rate, and then we have other taxes like national fiscal stabilization levy, and then we have another one, financial sector recovery levy, financial sector recovery levy. So these are the taxes that need to be paid. Let me copy this and paste it here as well. Let me copy this and paste here. So corporate tax rate is 25% for a bank. So we put a 25%. Or did I? Yeah. So the corporate tax, this has been the corporate tax rate. I don't want to work with the effective tax rate. I don't want to go historically calculating what has been the effective tax rate. I just want to go with the corporate tax rate as it is here. And these ones are 5%, 5%, 5% things. The manner in which those taxes were estimated historically, we are not going to be going through that GRE assessment and all those kind of stuff. or their own tax assessment, blah blah blah. I don't really care about that. What I care about more is just the tax rate that we have here. And so that's the reason why oftentimes you hear people saying that the tax rate for banks is 35%. Because you're taking a corporate tax rate, you're adding the national fiscal stabilization of 5% and fiscal sector or financial sector recovery levy also 5%. And that gives us the 35% that we always been mentioning. Now, the next thing you will do will be to look at let's see that you look at the other assets and other liabilities. So other assets and other liabilities. Let's see how it looks like. But then somebody is asking a question. Ibrahima, okay, you said for PPE and intangible, the base approach is calculated as follows: beginning balance, PPE or intangible plus additions minus depreciation and then ending balance. Yes, then I just need to define the keepers percentage of revenue or earnings and beginning balance. Oh yeah, the banks don't work like that, Ibrahima, because if we are doing this for industrial corporate, you are right to say that the forecast assumption can be built, maybe for keepers can be based on percentage of revenue, and that does make a perfect sense. I agree with you, or earnings or something, and oftentimes it's revenue, right? Keepers to revenue ratio and all that, but for banks are not in the business to be building physical assets or building PPs, right? Their biggest asset has to do with the loans. All in business to do is to grant deposit. In fact, if that will mean you don't have a physical presence and they can do this fully online, they can do that as much as possible. They want to even reduce the number of branches they have and all that. And even these branches, most banks don't own the building, they just lease it, right? So the depreciation and keeper stuff are not big matters for them to consider. For the keepers, especially, so we build it just to see that minimal investment will be made in keepers and in relation to to depreciation. When it comes to the depreciation amortization, you are looking at percentage of beginning balance. You can do that, but you see, the whole thing I'm saying is that if assets are bought in the course of the year, then it means you are ignoring depreciation. If your depreciation policy you want to go with is that asset bought in the or assets obtained in the year of acquisition should not be brought forward for depreciation purposes, then I agree with you. But what I'm doing is that I'm using a system where I'm assuming that asset bought in the course of the year must also add up to the depreciation, or depreciation on those assets must also be considered. So that's the reason why mine may be different from yours, right? But your point on the depreciation as percent of beginning balance is a correct method. I'm just using something a bit different from that. Thank you very much for that contribution. I really appreciate it. Now we are moving to other assets and other liabilities. So other assets. So other assets and other liabilities. Now, here, let me put them here first. I want to base these things on this because this is more like the classical receivables that we have in corporates and payables, right? So other assets are more of those kind of receivables and other liabilities are more of the payables. So other assets, I'm going to look at this outstanding. And then other liabilities, I will also be looking at here this outstanding. And then you may be wondering, based on what? Based on what I want to do is that for other liabilities, it's easier to say. For other liability, I'm going to be basing this on maybe operating expense days, right? And it's a bit difficult for other assets, given that we can base this on revenues or something. Even if you look at the nature of the items that the banks classify as other assets, right? So we need to come out with other asset days and other liabilities days. Now, a simpler thing I do to start with the argument is to base this on the operating expenses, total operating expenses. I'll base both the other assets and other liabilities on that, right? I each time I do that, it's not that I don't get results that are significantly different, right? But if you look at the historical analysis we did, we base it on year growth. So we have other assets growth and other liabilities growth. So these are not based on the days. Permit me to make a change here. I want to not to make a change, but to add two lines here on that. So other asset days, maybe let me copy this and paste here so that the formatting will be copied as well. So other asset days, call this outstanding. This outstanding, and other liabilities also this outstanding. Outstanding. And other asset days outstanding. Let's see how that is computed. Now, so let me set up the entire formula again. If error, we want to do this. We will take the other assets and we divide it by the total operating expenses. And I know in the past I tried to do this because it's a revenue driven item, or more, maybe let's say it's an income driven balance sheet item. I try to do it on the basis of other income, but it doesn't work quite well in most cases. But you also agree with me that if we have prepayment of expenses, is an asset. Prepaid expenses on the balance sheet is an asset. And what is it? It's an expense on a P&L, right? And so that's the reason why I think I can base that also on expenses. So I'll take the total expenses, but these expenses will not include the that will be total operating expenses, right? So it will include interest expense. It will also include fee and commission expense. So I'll not include fee and commission expense, and I will also not include, maybe I'll include fee and commission expense, sorry, but I'll not include interest expense. So it will be expenses from non-funded sources and also other operating expenses. So that will be fee and commission expense. Then I'll include operating expenses. Then I'll also include the operating expenses are two, right? Personnel and other operating expenses. Those are the things I include. So I'll come here and I'll go to the notes here, the cost notes here. I'm looking at three things. I'm looking at fee and commission expense. That's the first one. This thing started messing up again. 11. That's fee and commission expense. That D11. Then this as well, D12. Guys, what is happening is that my Excel is kind of messing up, right? D12 and D13. So these are the things I need. So I'm taking the, I need to complete this comma, not applicable. Okay, because of the if error formula. So what I did was that I've taken the other assets and express as percentages of those expenses. And then when I do that, I then multiply the results. I multiply the result by 365 days because there are 365 days in a year. So I multiply by 365 days. Okay. It's giving me error. I think let me put everything in. No, one thing I can do is that I know why this is coming. In the formula here, where I have my values, I'll just multiply it in there by 365. Multiply by 365. Yeah, good. It worked now. But I'm wondering why this is not applicable. I placed comma here. Oh, that's the reason. Okay, it worked now. Good. So I have 129 days and 3 number of this draft. So I have this. And then I do for liabilities as well, because I want my days to be complete numbers. I apply that. So I do for other liabilities as well. And I'll just have to copy the same formula. I don't need to do it twice and dump it here. Just that now it won't be other assets, it will be other liabilities, but I'm using the same denominator, which is the total expenses, right? Those total expenses I've done. So I hit enter, then I bring this here, one for the four. I have that. So these are the days, and I'm fine with this. I'm fine with this. So when I go to the assumption tab, the base case assumption, I'm looking at this outstanding other assets. I go to the other BS items tab and put the other assets, and I can drag down and get other liabilities as well and apply my comma. And then I can drag to the right. Good. And I don't need Kega. And it's already picking my average for me. I think that's fine. It's picking my average for me, and that's fine. Now let's check our progress. So we finished with current tax rate because, of course, we have the taxation, we have the rate, so we are cool with that. Other assets, we are done with it. Let's look at it. Current tax liability too will be settled because of that. Other liabilities will also be settled. We are done with other liabilities as well. Then let's see the are left with employee obligation. Employee obligation to finish with the liabilities. Employee obligations. Okay. So with our employee obligation, let's check it out, what we need to do there. I told you yesterday with our employee obligation, we need the net interest recognized in P&L. That will be needed. So the way we are approaching is we are looking at net expense, the expense here, the net expense here, as percentage of personnel expense, and also benefit paid, that goes to cash flow statement, as percentage of employee obligation. And which type of employee obligation? We're looking at the closing balance of employee, the opening balance of employee obligation generally. And there is reason why initially I've calculated it this way, but going forward, I'm making it of the a percentage of the opening. Okay, so what it means is that the opening balance of employee obligation, out of that, we are making the benefit payment, right? Good. So these are two things that we are going to use. Once we are able to forecast these two things, we will be able to forecast the liability as well. So let's go back to our base case scenario here. And then I want to forecast two things. So, sorry, I made a mistake. I want to forecast two things. So copy this. I already have those two things here. Employee obligation or defined benefit pension, right? Obligation, employee obligation. So for the employee obligation, we need two things. We're going to do the forecasting on this basis. So we have already calculated them. And so we just bring them up here. We have all this to do it. We have this. So we put these percentages then to one decimal place, and then the forecast is in this way. It takes the average, and I'm fine with that. The average of the historicals, that's what the forecast was taken, and I'm fine with that. So what have we done? We are done with employee obligation. And on the balance sheet, that is done. So the entire of assets, in the section of cash, that comes from cash flow statement, is done. Liability entirely is done. Equity, what can we do under equity? What we can do under equity will be more of dividend, right? Because the bank actually pays dividends, so we may come up with a dividend policy. That's the only thing we need to do there. So we come here and we want to set up a dividend policy for a bank. So we are going to do dividend policy. And the dividend policy often based on dividend payout. Okay, dividend payout. And so we need to come up with what has been the historical dividend payout. And that's a total dividend divided by the total earnings for the year. And how do we determine that? Let's check something quickly. I believe I've updated my equity to reflect all that. Dividend payment had been this so far. This year, some dividend have been declared. I'm not sure have been included in the 2024 financial statement. So you actually not see the accounts were actually signed off before then. I think will be included in 2025. I trust so. So it's always going to be the what we do is that the payout will be the dividend for this year divided by the earnings for the previous year, right? That's what we're going to do. So dividend for 2020 divided by earnings for 2019. So we're going to do something like that. So when we go to the base case assumption, 2019, because we don't have 2020 earnings, you're not going to mind that. We go to 2020 and pick dividend for 2020. And so we go here, pick dividend for 2020. Maybe something to do, we can put the if errors formula here. If error, so it handles all errors. And since we have if error, we can put in the full the full formula. And so we'll look for equity and look for a dividend. Dividend in 2019 divided by the earnings for the previous period, the profit for the previous period. We don't have, but look at what I'm doing. I put it here. It's going to give me error. So the error will be not applicable, right? We don't have. Then comma. I said these otherwise do not applicable. Not applicable. So not applicable here. Let's see how it goes. So not applicable. And then from 2020, it will start calculating. So we have this. Good. Another thing, because the dividend there is negative, I need to put the negative sign here so that converts the payout to positives. Okay. So convert the payouts to positive. So this is what we have. This is what we have. All right. So if you look at 2022, it may appear to you that the dividend payout in 2022 was 23.8, but that's not it. Maybe another thing we can do is that instead of structuring it this way, we can rather say that the dividend is paid in 2020, for instance, but it was declared in 2019, or it was as per 2019. So I know it's as per 2019, that's what we've done, but we will take it backwards instead. Wherever the income is made, that's the year in which we accrue the dividend. So in that case, if we are doing it like that, then I think we should rather do this because I don't want this to bring confusion, right? So when we go to the equity section, what I want to do is this. In 2019, the dividend paid in 2020 was paid out of the profit for 2019. So you pick the dividend paid in 2020 and divide it by the earnings in 2019, right? So that will be the 2019 dividend. So you have something rather like this. Good. In that case, it has moved away from 2022 because 2022 was when we have the DDP and the banks made losses, right? So this is a better thing to do. Okay, good. And then the forecast dividend, however, we can leave that one like this for now. We can leave it like this for now. Good. Good. We are making great progress. Now, so what we have done so far is the balance sheet. The P&L is not that much compared to the balance sheet. So let's complete the P&L as well. Let's complete the P&L quickly, and then we can transform these and then to various scenarios before even we start. We get it in various scenario forms. Okay, so we then put all these under others. Others. So group these under others. And then after grouping everything under others, we can further group them under P&L or under balance sheet. But maybe that's not necessary. Let's write from others. Let's start with the P&L. So on the P&L side, I want to start with revenue. So I have revenue to start with. And revenue, I would like to start with the issues of, since I'm dealing with revenue, the revenue is coming from multiple sources. I have to deal with the loans, the revenue from loans first. Hey, there's something we didn't do, guys. We didn't handle impairments. I don't know how come I forgot this. We didn't handle impairments. I thought I would do that later, but we need to do that quickly. I'm finding a place here and earning assets, and I want to handle the impairment there at once. Now, this is the issue with impairment. If you check the impairment for banks, the impairment, for example, let's take the loans and advances. They are charged on both on-balance sheet loans and off-balance sheet commitments. So in the off-balance sheet, you have the letters of credit and the other commitments, like commitments and guarantees on whatever way. So impairment is charged on both, but this is the whole idea. The impairment expense that goes to the P&L is a sum of the on-balance sheet impairment expense for the year and the off-balance sheet impairment expense for the year. Listen to that carefully. The impairment expense that goes to the P&L is a sum of the on-balance sheet impairment expense and the off-balance sheet impairment expense. But the one that goes to the balance sheet is just the on-balance sheet impairment. In other words, the accumulated impairment loss that we subtract from the gross loan to get the net loan is entirely for the loans and advances, meaning the on-balance sheet. The off-balance sheet accumulated impairment doesn't go to the balance sheet. That's why it's called off-balance sheet, the impairment on LCs and commitment. Now, this is the whole idea. Then you'll be asking, then how will we have the financial statement balancing? Because the impairment expense that goes to P&L is both on balance sheet and off balance sheet, but the one that goes to the balance sheet is entirely on balance sheet. Yes, that differential, which is the impairment expense for or the impairment on off balance sheet, is often added to another line on the balance sheet. Usually, it's added to liability. So most banks will include it under other liabilities, a component of other liabilities. They include it there, and that will cause the accounts to be imbalanced. Now, when we say the impairment, what we really mean, there are two ways to assessing this impairment. We have the Bank of Ghana directive, and we have the IFRS 9. The IFRS 9 is based on modeling, credit modeling. And with the IFRS 9, basically, what you are going to be doing is that you're going to be looking at or estimating the probability of default and all those kind of things. So IFRS 9 is basically about statistics, right? Statistics and probability. And so you are doing some form of credit risk modeling to be able to calculate the probability of default, the loss given default, then you calculate the expected credit loss and all those kind of stuff. We're not going into that. That IFRS 9. Then the Bank of Ghana directives here or method here, Bank of Ghana requires that or suggests that if you're using the Bank of Ghana method, you need to grade the loans you have. So the loan book, the various loans must be graded or must be you are going to put them into various buckets depending on the credit worthiness, right? So generally, we're going to have the loans classified into 5 buckets. The most credible loans are the ones we call the current loans, and there's definition for what constitutes a current loan. So maybe let me put those things here below. So we have what we call the current loans, and then or the current, we just call it current or current loans. And then we also have what we call the OLEM, right? The OLEM basically is what we call other loans exceptionally mentioned. But I'll deal with this soon. Then we also have substandard loans, and then we have doubtful loans. Okay, doubtful. Am I writing it properly? Yeah, I think I'm doing that. Doubtful loans, and the last one is the loss category. So there are 5, right? Good. Now, how do we classify loans under each of these? For current loans whereby the default from customers is less than 30 days. So when the default is less than 30 days, we call those ones current loans. So meaning that when interest and principal payment is due from a customer, and the customer delays that, but that is less than 30 days of delay, then we still consider those loans current loans. Now, so if, let's say, interest and principal payment from a customer is due on 30th April, and so the customer fails to pay on the 30th April. So the bank will wait from 30th April to the end of May. So end of May, then the bank, if the customer pays in between that period, that's 30 days after the due date, then we consider that loan still as current loan. All those loans that customers are able to pay less than 30 days. Now, if that's the case, though all the loans in that bucket charge 1% on them as amount, the value that could potentially default. I mean, the impairment charge on that should be 1%. So this will be 1% on gross loan. 1% on gross loans, right? Good. The second class is the OLEM. The OLEM have to do with those customers that fail to pay, within 90 days, right? So here we're talking about 90 days, within 90 days. So less than 90 days, if they're able to pay within, those customers that are able to pay within 90 days. So in this case, then it's like customers that were able to pay between 30 to 90 days. That's what it means when I say less than 90 days. This is less than 30 days. So this one will be from 30 days upward, but less than 90 days. Do you get a point? Now, globally, the definition of default is 90 days past due. If it is 90 days past due, then we say there's a default. That's the global definition of default. 90 days past due. So if a customer is able to pay within 90 days, it means that 90 days has not passed. So technically speaking and globally speaking, the customer has not defaulted. Now, in that case, the impairment charge should be 10% on gross loans. Okay, 10% on gross loan. Then these first two are actually the more credible region. And most banks that are doing well, most of their loans are in current loans, and then followed by OLEM, right? Let's come to issues of substandard. Substandard is where the customer fails to pay or is able to pay within 180 days, meaning the customer has defaulted. There's a default. It failed to pay within 90 days, but is able to pay within 180 days. That's substandard. And those substandard loans, those loans that the customers fail to pay within 90 days, but they're able to pay within 180 days, the impairment charge on them should be 25% of gross loan. So charge 25% on gross loans. Now, then the next category is doubtful. Those loans that they fail to pay within 180 days, but they're able to pay within 360 days. Those loans are considered doubtful loans, right? The customer failed to pay within 180 days, but from 180 days to 360 is able to pay. And that one, we charge impairment of 50% on it, and same thing on gross loan. The last one, and that is a loss region, is the one where it is above 360 days. You know, those loans that customers have taken more than a year, they have still not paid. That one, by the end of the year, if the 360 days has elapsed, then you make 100% provision on them. as loss. Consider it as bad debt, right? So 100% provision. So this is what the Bank of Ghana directives are. So this Bank of Ghana, right? Now, with this, the way and the manner in which interest income is accrued also matters here. So this is how impairment can be calculated. If I have access to, I say I have access to the historical distribution of this. Okay, historically, historically we can know the maybe the value of loans that are classified as current, OLEM, standard, doubtful, and loss. We can do that. When we're doing forecasting, maybe one thing that we can suggest to ourselves is that we can say that, well, going forward to adopt the same classification. So if 30% of the loans or if 60% of the loans are under current, then going forward, we maintain the current. If a percentage is under OLEM, going forward, we maintain that. If a percentage is under standard, we maintain that one. The difficulty with that is that over time, the current or the credit position may be improved, and there may be reclassification of some of the loans. Some may be moved from substandard region back to current once the customer is able to pay, right? And some may be moved from doubtful to substandard and all those kind of stuff. That migration from one region to another may affect any projection we'll be doing. So otherwise, I would say that, well, the bank is going to maintain a consistent proportionality. If 60% is in current, is going to be so going forward. And I'll use that basis to calculate the impairment loss, right? Yeah, so that's what I think about. But not really like that all the time. It's going to be difficult to actually do those calculations. So there is a simpler method I'll use for the purpose of our work. We don't have much time, right? For the purpose of our work, there's a simpler method I'll use. But then, guys, do you think we should use this? Let me see something in the chat. Should we use this approach? Since, of course, this is something which Bank of Ghana has been looking at. I think if not for anything, going forward, maybe we can adopt that. But what it means is that we need to group the loans. When we saying that gross loans, maybe our gross loans are growing. If the gross loans are growing, we also see the impairment also being maybe a proportional distribution, right, across. Nothing in the chart, but then I think I can go with that. Actually, I can go with this. So there is one thing I want to also let you know. Now, when it comes to how we accrue interest income, because if you have loans that are a loss category, the question is, should you still charge or account for interest income on these loans? Now, let me tell you the position of IFRS and the position of Bank of Ghana. Bank of Ghana requires that, well, if you have grouped their loans like this, you only accrue interest income on the first two. So interest income should only be accrued on the first two. So that's the current loans and OLEM. Meaning loans in the standard category, doubtful and loss category, we don't accrue interest income on them. That is Bank of Ghana. But IFRS is saying that, look, you can accrue interest income on all of them. However, for those in the substandard downwards, use a credit adjusted yield. Okay, don't just use the same yield you used to accrue or interest rate you used to accrue interest income on current and OLEM on these ones. Use credit adjusted interest rate, or effective interest rate, credit adjusted rate to accrue interest income here. Now, what we have been doing, we have been accruing interest income, or we calculated the earnings yield on the entire gross asset. Okay, gross loan. We didn't make decision between which one is current loans and OLEM and which ones are the substandard or whatever. So we are going to continue like that for the purpose of the work we are doing. Is that okay? Now, so I'm going to call this at the top here BOG. Let's say impairment of let's say BOG prudential impairment guideline. I'll call this BOG Prudential Impairment Guideline. That's what I'm going to call this. And then what we means is that we will have the distribution over time, and that is what we're going to use as the basis for the impairment charges. So these ones will not be changing. We have a constant whatever grouping. So we just assume that going forward, this is how the impairments are going to be charged, and that is throughout the period. That's what is going to happen. We will not be doing anything more than just that. In the actual impairment calculation, let me do this format. In the actual impairment calculation, we will do the detail work, right? But for the purpose of what we have here, this is how the impairment guideline is going to be. We'll look at the historical distribution of the loans, and then based on that, we use that to forecast the impairment going forward. And so that is a story for impairment. I want to complete the rest of the things here and do some things before we close for today. I know we will end up closing like 8 o'clock today. Just bear with me, guys, for today, because we are far behind time. So tomorrow will be for us to complete the modeling. Our idea is to complete the financial modeling tomorrow. And so once we set up the pages like this, it's easier to complete tomorrow. What happens if we recover part of the lost ones in the future? Yeah, if we recover part of the lost ones, and then we'll do reclassification. So what it means is that the loans that are classified as lost will then be reclassified to the other buckets. Now, there's something that came to mind. I told you that Bank of Ghana says don't accrue interest income on the substandard doubtful and loss, but accrue on only the current and old. But let me add something to it. You see that the banks will still, in the ordinary way, accrue the interest income on these ones, the substandard through to loss. But those interest income are often accounted for on the financial statement as interest in suspense. They'll put it in suspense account. Okay, they'll accrue it, but they'll put it in suspense account, just in the hope that the customer comes to pay, right? Now, so we come to revenue, and let's do that quickly with revenue. Revenue, we'll start with the interest income first. So let's do that quickly. Interest income for the revenue. And so interest income is the first revenue item I want us to look at here, interest income. And that's, if we get to revenue, ladies and gentlemen, I want to move the worksheets here so it's closer to me. When we go to revenue, we'll see the interest income, we'll have the growth rate, we look at all this, and I told you that I'm not quite, what is it? No, I think, here is interest income. I'm not kind of a fan of the growth rate, and also the relative. I think it's more of the yield. The yield is what we will be interested in. So we are going to be using the loan, the yield on the asset and all that. That's what we're going to use as basis for the forecasting, right? So I copy this, and then I come to the base assumption, and I drop it here. Now, these are the yields. And then I'll need the yield for the industry as well. I may need industry loan yield. So I get the average asset yield for industry as well. And when it comes to the macroeconomy, what I'll be interested in here, I'll be looking at the average lending rate. That is what I'll need here to validate some of these figures. I'll need average lending rate. So the loan yield and all that, I'll go to revenue, and I'm looking at loan yield here. I take that and I drag it to the right, and KIGA is going to be not applicable throughout. KIGA will be not applicable throughout. And then I may want to start this by forecasting it on the basis of the average, right? Average historical yields. And if you look at it, one thing I like about GCB is that their yields are quite stable. Look at the yields, it's quite stable, right? And look at the investment security yield as well. And even in 2022, look at the yield where we have the GDP, but the yields are still very stable. You look at cash and short-term funds, the yields are quite good, right? Average asset yield for the industry. So let's do that calculation quickly. For the industry, we have the interest income. Let me just do the calculation for the yield. Now that we have interest income, so I'm looking for the average yield. So I don't care about whether it's investment securities or loans. So I'm just looking at average yield. Average yield on earning assets. So let me delete this particular one. I want to get the average yield, and that is the interest income I have here divided by the sum of the investment securities and the loans. So gross loans plus investment securities. I have them here, the two, and then I'm gone. So this is what I'm having. But this is not too good for me. Not that it's not too good for me, but in year 2020, I think I can start working with averages from this 2020 average investments or earning assets. So that is in that case, I'm going to do the 2019 earning assets and 2020 earning assets. I'll take the average. So 2019 loans and advances plus investment securities, comma, then 2020 loans and advances plus investment securities. So I'll take the average of that, hit enter. There's a few arguments. What do I have? It's an error. I think I need to take up this, then I'm gone. Yeah, good. So this is more reliable. But even if you look at the figures that I'm getting, let's see whether I have all the data points. I have for interest income. Let's see for gross loans and investment. 2024 is not a good year for me. 2019 is not a good year. So I'm going to rely on 2020 to 2023. 2020 to 2023. Those are the years that I have the full data. 2020 to 2023 are the years I'm going to work with. 2020 to 2023. So let's see 2020, then right to 2023. So I will rely on these ones. Let's see. Okay, so that's not too bad. No, do I see that's not too bad? Look at it. Is there something happening? Am I getting the true values? I'll need to check. Do I need to check this again? No, I think there's a problem. There's a bit of a problem somewhere in terms of the interest income. Guys, I'll have to check that again, right? But then when we come tomorrow, I'll populate this. I think this is not a true interest income. I think the data my team populated for me. I think there's a bit of an error with the interest income. So I'll handle that. I'll handle that before tomorrow, the lecture tomorrow. Now, so you need to, and I'll populate here also for an average lending rate, right? But then we are building a basic model. So here's something we're going to have, and that's what we're going to use as basis to build a model. The second thing will be fee and commission. Let me see. What's the next thing for revenue? Fee and commission income. And fee and commission income, the projections, one thing I want to do is that the projections will not be based on directly on the growth rates because of something I want to show you here. So with the fee and commission income, this is what we're going to do. And follow me. Number one, we are going to determine the growth rate in the entire non-funded income. That's the approach we are going to use. You determine what the growth rate will be for non-funded income. Non-funded income. Non-funded income. So you look at non-funded income year-on-year growth. Year-on-year growth for non-funded income. And then based on that, you calculate the growth in other incomes. So the non-funded income, I've calculated already the total, you see, total non-funded income growth. So I'm picking that one, the growth in total non-funded income. And also, I need to calculate the KIGA in respect of that. Since we are dealing with growth, I can calculate my KIGA now, 5. And then the present value, here for non-funded income, I have that here. And the future value here, I have that here as well. So that's 22%. That's not too bad. As KIGA is fine. I can do my prediction for the future based on the KIGA that I have here. I can start the projections based on the KIGA. Okay. Now, once I get my non-funded income, I can do projections for the rest. And so I can handle my fee and commission income now. And what I'm going to do, I'll need for the top 5 banks as well. So fee and commission income can now be forecasted. So I have fee and commission income. And then fee and commission income, there are a number of things I need to do under fee and commission income. If I go to revenue, I can get a fee and commission income. I need fee and commission. I don't need a growth rate in fee and commission income because how erratic the growth rate is, it's not quite good for me to do the projection. I would rather be interested in fee and commission income as percentage of total non-funded income. I need that ratio so that once I forecast what the total non-funded income is, I can just indirectly calculate the fee and commission income as well. So I need that. Then once I get this relationship, the fee and commission income as percentage of non-funded income, I can calculate fee and commission income. Once I'm able to calculate fee and commission income, I can also calculate the various components of fee and commission income. So I'll look for the component of fee and commission income, and I can calculate them as percentage of the total fee and commission income I forecasted. So I pick this. They are 5 in number. I pick that and I paste them here. Good. I paste them here. So I have these ratios that I need. So let me pick some few things here now. So I need the fee and commission income as percentage of total non-funded income. So what do we do? I go to the revenue. I look for fee and commission income as percentage of total non-funded income. So I think I've done those calculations here. Yes, they are here. Fee and commission income as percentage of total non-funded income. I pick that. Then I need the various components of fee and commission income to total fee income. So I go to fee and commission income down here and I pick them. So I can drag this down. And then once I drag down, I can then drag to my right. So I have that here. And since I'm dealing with relative measures, I don't need KIGA. KIGA is almost useless for me. Now, I may be dealing with averages throughout. So I want to deal with the average. As it stands now, I want to do with averages. I know there are issues when you deal with averages for relatives, right? When you deal with averages for relatives, there are issues, but let's just leave it the way it is now. The reason why there are issues is this. Let me show you something. If I come here and I sum up all the averages, or sorry, I sum up the relatives, it's 100%. Okay, it's 100% the sum, because the sum of the relatives or proportional something distribution should be 100%. But when I come here and do it, I won't get 100%. Oh, sorry, I get 100%. That's beautiful. So in some cases, you may not get 100%, but here I get 100%, and I'm happy. I'm happy I get 100%. Good. Sometimes you may not get 100%. So it's good I had 100%. For the top 5 banks, I also need, let me see what I have for top 5 banks. I need non-funded income to fee and commission income. Yeah, I need that for the top 5 banks as well. So I need non-funded income to so let me just copy this and please. I need this as well. So I can calculate that for the top 5 banks as well. So I will just go copy the formula, what we've been doing here, the key performance indicator, and I'm looking at the fee and commission, and what I want to calculate, or what is of interest to me, is the fee as percentage of non-funded income. So which is basically taking the fee and expressing it over non-funded income. So that is it. We have here 63%. Wow. So this for the market, right? But Fidelity has not been populated. I don't know why. So that is all we have. So we come to the base case here, and then we have that also placed there under the base case to start with. Okay. Wonderful, wonderful, wonderful. So fee and commission is gone. You see the methodology we use to project fee and commission. We're going to use the same methodology to project items like, net trading income. So we come to net trading income, which is the next revenue item. Net trading income. So with the net trading income, we going to also go with the net trading income as percentage of total non-funded income to start with. So we go to the revenue tab and we look for net trading income. There are 2 items there, but we need net trading income as percentage of total non-funded income. So do we have it here? Yes, we do. Yes, we do. And it is this one. So we are going to, so the whole idea is that the growth rate will apply to only non-funded income. Once we have the non-funded income growing, the rest will just be a percentage of the non-funded income, right? That's the whole idea behind what we're doing. And then we go to the revenue and we pick so we look at the relatives, right? Once we're able to forecast the net trading income, then we can also forecast or distribute it across the various components of net trading income. That includes things like the foreign exchange and the fees income trading, right? So let's have that also here. So then I can delete the rest to create some space here, and then I can have, for the industry, I'll have net trading income as percentage of no. But you see, the whole idea is that because of how volatile these revenues sources, which is net trading income, I don't care about what is happening in the industry. So I don't even care about industry matters right here. So here we go link, we pick the non-funded income as percentage of, the net trading income as percentage of net non-funded income. I pick that, and then we drag it to the right, not applicable for KIGA, and then the rest of them we go under the net trading income, and then I pick that here, I think here, right? And then I have this. It tells you that for GCP, most of the net trading income are coming from forex trading rather than fixed income, right? And over time, fixed income started to dominate forex. Fixed income started to dominate forex, and the projections are still based on average, and which is not too bad to start with. The projections are based on average. What is the last thing to project based on maybe instead of calling this revenue, let me rather call it income, so that since it is income, I can do the last income item, which is other income. I told you the other income is not revenue items, right? Other income. So the assumption for other income, and other income too, we're going to do similar thing. You do other income as percentage of non-funded income. Other income as percentage of non-funded income, and the rest for other income will be the other income. Sorry, once it's other income, because it doesn't have any, it doesn't have a breakdown, right? So it's just other income as percentage of non-funded income. So once we grow the non-funded income, we have the other income too. So we just go and pick it up, go to revenue, and then pick other income as percentage of non-funded income. I have it here, and then we drag it up, and then pick the average. The CAGR is nothing there. It's not applicable. So we are done with the income. The last thing we are left with for the day is expenses. So let's handle expenses or the cost. And then once we finish the cost, then we'll do one thing, and then we are done for today. Then tomorrow, you put all the figures together, and then we'll have a model. Okay, so ungroup here, and let me group this one, and group these. Then we are left with the cost to handle. Now let's go to the cost side. Cost. Let's bring the item and the cost there. So we move it closer to the base assumption. Cost. So cost, we having 4 elements. We need to build model for. We need to build assumption for 4 elements, and that will be the end. Let's look at it now. So we going to have cost. Let me copy this and paste it somewhere here, and I'll call it cost. So I'll call the first one interest expense. And interest expense, to just like interest income, we're going to focus it based on the expense cost of funds, right? I wanted to say expense yield, but the correct thing to say is cost of funds, right? So we have CASA cost of funds here. Then we have this is supposed to be borrowed. I don't know why I wrote it. CASA cost of funds. We have time and other deposit cost of funds. Then we have borrowing cost of funds. So there are 3 we are going to be dealing with. So let me just copy that there. So the same way we have the loan yield and all that. For the interest expense, we're going to look at cost of funds, how much it costs us to gather funds from those sources, right? Good. Okay. So then we will have the average cost of funds for the industry as well, cost of funds for the industry. And the macroeconomic side of things, you have average savings rates, the yield made on savings accounts, right? On average for industry, we have that as well. We use that as the macroeconomic stuff. There. Now, so CASA, cost of funds, we go to cost, and we are looking at CASA cost of funds 2019. We pick it up from here, and then we drag that, and then we down and then to the right. Average cost of funds for the top 5 banks, we can go here. We have, now let me see if I have your interest expense. Yes, I do. So I have interest expense here. So we can copy this. The same way we calculated the yield, you see average cost of funds for the industry. Average, let's see whether GCB is doing better, cost of funds. And average cost of funds will be, but you see, the issue here is that because I'm working with just deposit, the average cost of funds I end up having may not be a good reflection, right? So it should be cost of deposit, because for the industry I'm working with just deposit. So the average will be the interest expense here divided by deposits, total customer deposits. And the good thing is that this one I have the full data, so I'm going to have something correct. But the whole idea is that going forward, and I'm dealing with averages, right? So average deposit. So that should be the deposits at the beginning of the year, or last year deposits and this year deposits, and I take the average. So last year deposits, comma, this year deposits, the average of the two. And that's what I'm interested in. So I entered too many. Okay, I have to take off one of the distance here. So going forward, this one I'm going to have, and this is not too bad. Look at the deposit rate. Now let's come to this place and bring those deposit rates there. So this is average deposit rate. I'm going to edit that so I don't make any mistake. I don't communicate something wrongly, something to mean something else. Average cost of customer deposit. Now, so in this case, if I take this 4.2, well, overall, if we calculate overall average cost of deposit for this bank, look at it this way, you see that the average cost of funds is about 3.8, 3.7, 3.5, 4.3, 4.1. But it includes expensive deposits, right? But then you also tell me that one error I'm making here is that I'm taking total interest expense, I'm expressing it over only deposit and not including borrowings. Maybe I'll update this data to include borrowings, because before we formalize our assumptions tomorrow. Now, so I picked the average as well, as usual. And so that is interest expense. Let's do for the next one, which is on personnel expenses. Personnel expenses, the next one, let's do that. So personnel expenses, I think I have that. Yeah, personnel expenses. Now, personnel expenses, when we check the cost side here, no, I have fee and commission expense before I go to personnel. So let me deal with fee and commission. It's just one item, and it's actually expressed as fee and commission expense as percentage of fee and commission income. So it's even straightforward, right? And so let me put that here. Then I delete this fee and commission expenses. So expenses, and so here fee and commission expenses, we've calculated that already. So I'll just go and pick it up from cost. Fee and commission expenses as percentage of fee and commission income. So I have that here, and it's going to pick the average, and I'm cool with that. And then from here, I can do with the personnel expenses. So personnel expenses, the next one I want to deal with. Personnel expenses, let's see how it looks like. Personnel expenses. How many items below that? That's where we start having a huge items. A lot. But I see, one thing I'm going to do is that I don't want to do the projection for personnel expenses for individual items. I don't want to do it separately. I want to grow the entire personnel expense. And then when I do that, I can then distribute the growth among them. So I'm going to work with personnel expense growth rate itself, the overall growth in the personnel expenses to check, to start with. Secondly, I will then do the distribution. So I'll work with the relatives rather than the absolute. I'll work with the relatives rather than the absolute. I mean, rather than the year-on-year growth. So I'll put that also here. And then let me delete, oh, sorry. let me drag these things down to the level of so that all those things will copy in there. I delete this. So I need the personnel growth rate, and let's check it out. Personnel, I have that here, and I also need the relatives. So I look for wage and salary as percentage of personnel expense. I pick it up. I can actually drag the relative down and then to my right. And then I also drag the growth rate to my right. And with the growth rate, I can look for KGA. Since I'm dealing with growth rate, I calculate my KGA 5. Then I go to this place and I pick the KGA growth and determine the KGA for personnel. That's 18.8%. That's the only one I'll calculate the KGA for. We're making great progress. The last item to calculate on the P&L is other expenses. Now, so with other expenses, let me copy that and come down here. With other expenses, this is what we're going to do. With other expenses, we are going, let's look at other expenses again. And that's a lot there, and that is the only one left. So other expenses, this is what we're going to do. We have about how many items here? They're about 20. But you see, we are not going to use the year-on-year growth for each of them separately. You'll do it for the total, like the same way we did for personnel. And then for the rest, you just use the relative. So let's do for the total. So you pick for the total, as we have it, for the total, and then the rest, we're going to do the relative. So the relative starting from here, and in fact, the financial analysis we did it on the basis of the relatives, right? So we come here and then paste this here. Okay, so we have all of them here. And then we can also drag, we keep dragging to the last one. We keep dragging to the last one. So we go take the other expenses, we go and look for other expenses here. And where is it? We find it here. We bring it, we drag it to this side, we calculate the KGA. So IRR, do I see IRR now? RRI, guys, then 5, then we go to cost and look for the total at the beginning and total at the end of the period and the review. Got 19.7. And then the rest will be the relative. We go pick them, the relative here, we drag down and then to the right as well. So that gives us the relatives. Wonderful work, wonderful work, wonderful work. What we've done so far, we've been able to put together the assumption sheet. And let me group the things properly, and then I'll show you something before we leave here today. I know today I've exceeded the time, the same way sometimes I close it, right? And so today, just bear with me, because we don't have enough time on our side, so you got to bear with me. Okay. Now, so we have this done now. So if I collapse this, I have all my assumptions well structured. So I have a funding assumption done, and so we're just going through them, right? Funding assumption done, earning assets done, other investment and financial asset done, fixed asset done, then others. Then we have income and we have costs. So let's go through the funding. We know we have a customer deposit checked. We have a deposit from banks and other financial institutions checked. Borrowings check. There's a reason why I need to go through all these things, right? I'll show you soon. Then we have earning asset, gross loans, asset allocation, so we can get the investment securities. Then gross advances to bank. Then BOD prudential impairment guideline. We have it here for impairment. Then we have other investment and financial assets like non-pledge trading, investment in associate, investment in subsidiary, all done. Then we have a fixed assets, policies, and staff, all done. Then we have others here, taxation, other assets and other liabilities, employee obligation, dividend policy. We have our income items here, like interest income, non-foreign income to get fee and commission income, to get net trading income, then other income. We have the cost elements here, and that includes interest expense, fee and commission expense. Then we have personnel expense and other expenses. All done. Let's check. I think that is all that we need. Now, with all this that we have, what is next to be done to get the whole work completed or to get going? This is what I'm going to do now. I'm going to rename this. I'm going to create another sheet. This is my base case, but I'm going to create another sheet. I'm going to call it, I'll call it, that will be the sheet after the base case. I'll call it my best case, and then I will create another one. So that by best case, let me edit this thing here. We are just going to create sheet and do something on sheet and close. Okay, I'm not going to. I want to complete that before we close today. So tomorrow, when we come, we are going straight to start the homework. I don't want us to do this again. Then we have the worst case. So let me change this to worst case. So you see why we need to complete one whole one before we do for the rest. So we have base case, we have best case, we have worst case. Good. Now I'm going to create another one. And I'm going to call it, I'll call it the life case. So maybe let me just add the cases to it. Worst case, best case, then base case, then I have life case. Now, so I have life case, or just say life. I'll explain what I mean by life. Now, we are going to put in some instructions. So we set up a simple algorithm, and we want the algorithm that, depending on the one we want to work with, the algorithm will automatically change all assumptions on the live sheets, right? So that's why we have the live sheets here. So I'm going to set up something here. I'll call it the live case we are working with. So always we know that this is the live case. We will know the case we are working with all the time. So the live case, let me change this to this color, live case, and then this color, let me make it the blue. And so I'm going to call this, or maybe let me use black. Let me try to use the balance colors. And this one, let me use the gold, right? The gold color. So live case. And so this case here, I have here, I'm going to do some data validation, right? So I go to data, and then I look for data validation. And in data validation, I want to create a list. And the list here, I want the list to be as follows. It should be base case. Comma, best case, comma, and then worst case. Then, so all this should be in quotation, because these are string variables, right? So enter. So when I enter, I can actually select any case at all. I think there's a problem. I shouldn't have put them in string variable. I'm sorry for that. I can still do them without putting them in string or presenting them as string variables. So I have this. Oh, I'm coming, guys. What is happening here for me? Then, okay, so I need not to bring any space. So I need not to bring space. Then I have here also, I take off this thing. So I just bring the comma. So look at what I've done. I just brought in a comma all through, right? Just a comma. I click enter, and then I can have all my scenarios here. Base case, best case, and worst case. I can switch in between the various scenarios, right? I'm going to switch in between them. And I'm doing this on the live one, right? And let me format this space white, and then I'll do black. It will be black. Sorry, do I say I bold it? I'm sorry. Now, there's something I'm going to do. This live sheet is what I'm really going to be working with. Sorry, guys. So this live sheet is what I'm going to really be connecting things to. So what I'm going to do is that I'm going to link the entire model to the live sheet. And I'm going to structure the live sheet such that the base case, the best case, the worst case will be there as assumptions, separated. I'm not going to link the model to them. I'll link the model to the live sheet. So if I switch that, hey, go and use base case or best case or worst case, then the input here will automatically go and pick the base case, the worst case, or the best case. Now, so because of so that is how things are going to be, right? So what I'm going to do is that I am rather going to link these sheets here to the ones or to the base case and the best case. Let me just do for one and to show you that is what is going to be happening throughout. Now, the rest. So let me just do for one so you see. I'm going to use a function. And the function I'm going to use is called switch. You can use choose to also do the choose function, but I'm going to use the switch function. Now, so how I'm going to use this function here is that I'm going to use the function and I will say that, well, if I pick, maybe I'm receiving this thing here. Now, I'm going to use this function and it's such that when I pick, maybe based on the base case that I'm going to pick here, when I take a base case, suddenly I want a certain result to be provided, and then so if it is base case, then I want you to go to the base case sheet and produce something out of the base case. If best case sheet or whatever, maybe let me just leave this out so that we given the time here, so that we'll do it when we meet the other time. But what is going to happen is that this live sheet is the one I'm going to connect the entire model to. I receive a notification on something I need to close at this time. So when we meet, we are going to connect this live worksheet to the base case, the best case, and the worst case by using the switch function. And now, so when we do that, we can, all we need to do is just to use this drop down button to change in between, and our model will be changing. In that case too, because we are building this Excel sheet so that we'll end up getting to the level of the valuation worksheet, the valuation workbook will all be changing. The value of the bank will be changing based on the various scenarios we are using. And that will help us in doing scenario analysis for the purpose of the valuation. So I'm deleting all this here, only in the live sheet, because in the live sheet, I'm going to connect the 3 scenarios there. And so any change you are going to make will not be happening in the live sheet. Will be happening in the various scenarios, but on the live sheet, you can be using the buttons to change things all across. So that's how the live sheet is going to work, and that's how the whole procedure will be carried out and going forward from tomorrow going forward. Now, so I want to bring the lecture to a close here today, and as it stands now, you can see exactly what I'm intending to do, and I'm just deleting everything from the sheet here, and then leaving out the rest, the base case and whatever, and this will be the live case that will be changing, and that's how we can build scenarios in Excel for the purpose of financial modeling. Yeah, instead of you going through the hard to use if statements and all that, using this alone will solve a whole lot of your problems. Okay, great. Now, any question? Any question? I have some few people that have been with me all this while. Just put something in the chat as we always do, before we close from today's on. Put something in the chat. I know today I've been quite hectic, but then I think it's understandable as well. You agree with me that there are a lot of things left to be done, and now we have our assumptions all set up properly. We have the base case, the best case. Even though the scenario we are working with now is a base case, but we'll go back to make changes to the best case and all those kind of stuff, right? But once we set up the model with just a single case, it runs through the rest. Another great session, so much learned, and looking forward to tomorrow and the rest of the sessions. Thank you so much, Julius. Thank you very much, Nelson. And let me have some 1 or 2 more messages, and then we are done for the day. Then people can go and watch Champions League. In fact, a lot of people want to go watch. A lot of people, I believe, have even left to go watch Champions League. So the rest can also follow suit to watch Champions League. So let's see how it's going. Insightful today. Thank you. Let's see how it goes. Thank you very much. And if really anything from you, and then Prince, thanks for the detailed template. We can still refer to the recording on YouTube and get on practice on a lesson. Yeah, that's true. If really anything from you today.
Not much. For those who are interested in the scholarships, kindly know that the deadline is the 19th of this month. So if you have started the process of applying, kindly note that you have up to the 19th. We will be back tomorrow. So thank you for today, Julius, and good evening, everybody.
Thank you too. Good evening.